Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so let's set the stage. Tuesday, February 3rd, 2026. Silicon Laboratories, ticker SLAB, it closes the day at $136.62. Volume is, well, it's completely normal, barely a blip.
Right.
Then Wednesday hits, and the dam just breaks. By the end of trading, volume explodes to, 7.11 million shares. The stock just rips higher, it hits an intraday peak of $207.38, and then, settles around 203.21.
A massive move.
I mean, that's a 51% intraday gain. It's a 69% premium over the unaffected price. And the catalyst is crystal clear. Texas Instruments is buying them. A definitive agreement, $231 per share, all cash. A $7.5 billion deal.
And right there, that is exactly where the trap opens up. You see a 51% gain, and I see a hard ceiling. That 231 offer, that's not a target, It's a cap. And any investor buying in now at, $203? They're looking at a deal that isn't expected to close until the first half of 2027. That's a 15-month wait. You're locking your capital up in what is, it's a merger arbitrage play with some very serious geopolitical baggage attached. So the question isn't whether this is a good company. The question is there any juice left in this lemon for a new investor today?
I see why you'd frame it that way, as a trap. But I think that really ignores the strategic reality of this. This deal is a masterpiece of execution. It validates the entire pure-play IoT pivot that the CEO, Matt Johnson, has been orchestrating since 2022.
It's a big payday, I'll give you that.
It's more than that. We're talking about a $7.5 billion valuation for a company that was trading at, $4.49 billion just a few days ago? Texas Instruments isn't just, throwing money around. They're paying this premium to reshore Silicon Labs designs into their own 300-millimeter wafer fabs. This locks in value. For an investor today, that spread between 203 and 231, it represents a high probability yield in a market that is looking, increasingly volatile.
You call it a high probability yield, I call it dead money with binary risk. Let's actually look at the valuation metrics for a second because they are screaming. Silicon Labs currently has a negative PE ratio. It's minus 51.8. Their price-to-sales ratio is hovering between 5.6 and 6.1 times.
Okay.
Now, compare that to its peers in the semiconductor space. NXP Semiconductors is trading at roughly 3.8 times sales. ST Microelectronics is even lower. So Texas Instruments is paying a massive luxury premium for a company that, quite frankly, has been struggling with profitability coming out of that 2024 inventory correction. And if this deal breaks, and we really need to talk about why it might, this stock doesn't just slide, it collapses right back to the 130s.
Well, I'm not convinced by the dead money argument because I think you're looking at trailing metrics instead of the strategic asset here. That negative PE, that reflects the heavy R&D investment into their Series 3 platform, which is exactly what Texas Instruments wants. They aren't buying past earnings. They're buying the future of edge AI. But, let's step back. The market has spoken. That 7 million share volume, the smart money is voting that this deal makes sense.
Volume is just noise without context. It's arbitrage funds moving in, it's not long-term believers. But okay, let's dig into the business itself. You mentioned the pure play IoT pivot. What exactly is Texas Instruments buying here? Because on paper, SLAB is a fabless company competing against absolute giants.
Yeah, and it's important to clarify that term fabless. Yes, they design the chips and outsource the manufacturing, but what they're really selling is silicon as a platform. So they generate revenue through two primary segments. First, you have industrial and commercial. That makes up 57% of their revenue. And this isn't just selling a chip. This is smart metering infrastructure in India. It's building automation, commercial lighting. It's infrastructure.
Right, but aren't those pretty commoditized markets? Everyone makes a radio chip.
Not the way Silicon Labs does it. They aren't just selling the silicon. They're selling the Secure Vault security suite and the Simplicity Studio software. It lets a developer write code once and then deploy it across different protocols. Then you have the home and life segment, which is the other 43% of revenue. This is where you see the high-growth consumer tech, glucose monitors, smart locks, things that need to run on a tiny battery for 5 years without failing. That reliability, that's the moat.
That does sound impressive, but I have to interrupt on the competitive moat. You mentioned glucose monitors, smart locks. Their biggest competitor in the Bluetooth low-energy market is Nordic Semiconductor. And Nordic holds an estimated 43% market share. I mean, Nordic is a beast in this space. Silicon Labs the challenger.
Sure.
And remember, Silicon Labs is smaller than the big integrated device manufacturers, the IDMs, like NXP or STM. They don't own their own factories, and that exposes them to supply chain shocks. If TSMC raises prices, Silicon Labs takes a margin hit. Texas Instruments is an IDM, so why would they buy a fabless company that's exposed to all that foundry volatility?
That is precisely the genius of the deal. You've identified the weakness, the lack of fabs, and that is exactly what Texas Instruments solves. Texas Instruments plans to move Silicon Labs production into their own internal 300mm wafer fabs. That reshoring completely eliminates the foundry markup. We are talking about $450 million in annual synergies within 3 years. That is pure profit falling to the bottom line just by changing where the chips are made. It turns a weakness into a margin expansion engine.
That's a compelling argument on paper, yeah. But have you considered the execution risk of porting those designs? Moving a complex Series 3 chip from a TSMC process to a Texas Instruments internal process. I mean, that's not like copy-pasting a document. It takes years of requalification. And while they're distracted doing that, you know Nordic and NXP aren't sleeping. They will be aggressively targeting SLAB's customers during that whole transition.
3 platform they showed off at CES 2026. It's built on a 22-nanometer process. It's designed for edge AI. We aren't just talking about connecting to Bluetooth here. We are talking about processing voice commands and image recognition directly on the device without ever going to the cloud. And it supports the new Matter standard, which lets devices talk to Amazon, Google, and Apple ecosystems all at once. Texas Instruments has the analog catalog, but they need this digital wireless protocol expertise to complete their package.
The tech is fine. I'm not disputing that Series 3 is a good chip, but let's look at the financial health leading up to this. You mentioned the recovery, but let's look at the insider activity. It tells a mixed story at best.
Actually, I think the insider story is one of the strongest bullish signals we have. Look at late 2025. CEO Matt Johnson and CFO Dean Butler, they didn't just hold shares, they participated in the Employee Stock Purchase Plan, the ESPP, in October 2025. They bought in at $86.46. That's a voluntary commitment of their own cash. It signals they knew the intrinsic value was massively disconnected from the share price long before Texas Instruments ever showed up.
Fair point. Buying at 86 was a great trade. They doubled their money, but look at January and December. Senior VP Brandon Tolani and Director Nina Richardson, they were selling. Tolani offloaded over $870,000 worth of stock. If the deal was such a lock, why are they taking chips off the table right before the announcement?
But those were 10b5-1 programmatic sales. Executives diversify. You can't read too much into scheduled selling, but what you can read into is the massive institutional accumulation. AQR Capital increased their position by nearly 2,000% in Q3 2025. The smart money sniffed this out. They saw the 34% year-over-year revenue growth in 2025, hitting $785 million, and they positioned themselves.
Or they just got lucky on a binary event. But okay, let's bring this down to brass tacks for the listener. We have a lot of people listening who might be thinking about putting some money to work here. Let's do the actual math on a $5,000 investment at the current price of, roughly $203.21.
I think this is a crucial exercise. Yeah, walk us through it.
Okay, so you have $5,000. At $203.21, you buy approximately 24.6 shares. The deal price is $231. That is a fixed number. It is not going any higher. So if you hold those shares for the full 15 months until the expected close in H1 2027, your gross profit is roughly $682.
That's a total return on investment of 13.65%.
Which is a very respectable return. I mean, it substantially beats inflation and cash yields.
But is it enough for the risk? That's the real question. That works out to about 10.9% annualized. Now consider the opportunity cost. If the semiconductor index, the SOXX, goes up 25% in 2026, which is entirely possible given the AI boom, you've effectively lost money relative to the market. You're buying a bond that pays 10.9%, but it carries the risk of an equity disaster. If the deal fails, you don't get your principal back. You lose 30%, maybe more, immediately.
Where valuations are stretched, where else can you find a near guaranteed 13.65% return? I mean, that beats cash, it beats treasuries, and it beats corporate bonds. And, there is a short-term play here too. If positive regulatory news hits in the next 3 to 6 months, the stock could creep up to 215 pretty quickly as that risk premium compresses. That's a quick 5.78% ROI in just a quarter or two.
If positive regulatory news hits. And that brings us to the elephant in the room, the regulatory hell this deal is about to walk into. We are in the middle of a full-blown chip war.
I suspect we are going to disagree on the severity of this.
Oh, we absolutely are. This deal requires approval from the State Administration for Market Regulation in China, SAMR. And even though Silicon Labs is relatively small compared to, an NVIDIA or an Intel, SAMR has been incredibly aggressive. They view every merger of U.S. chip companies as a potential threat. They could delay this for 24 months, or they could just block it entirely as a geopolitical pawn.
That's a risk, certainly. I won't deny that. But look at the nature of the deal. This is not a horizontal merger where two competitors are combining to jack up prices. This is vertical. Texas Instruments and Silicon Labs have complementary portfolios. And more importantly, the U.S. FTC and DOJ, they usually like reshoring. This deal brings manufacturing back to the U.S., or at least into TI's internal network. That aligns with U.S. strategic interests.
The U.S. regulators are unpredictable, though. They are terrified of so-called killer acquisitions, big tech buying innovators just to stifle competition. But let's stick to China. If SAMR blocks this, Texas Instruments pays a breakup fee of $499 million. That sounds like a lot. But does $499 million fix the stock price? No. If the deal breaks, SLAB goes back to trading on its fundamentals. And on fundamentals, without that TI premium, it's a $130, maybe $140 stock. You are risking a $70 drop to make a $27 gain.
I'm just not convinced by that risk-reward characterization. That $499 million is a very strong deterrent against Texas Instruments walking away voluntarily. They are committed. And regarding the killer acquisition theory, Silicon Labs has 100,000 customers. They are widely distributed. This is not buying some startup to kill it. It's buying a platform to skill it. The synergy logic is just too strong, $450 million a year, for TI to let this fail easily. They will fight for it.
They might fight, but they can't force China to sign the paper. And let's talk about that timeline again, 15 months. H1 2027. A lot can happen in the macroeconomy in 15 months. If we hit a recession in 2026, IoT demand dries up. Silicon Labs is fabless. They get squeezed. And suddenly that $7.5 billion valuation looks exorbitant. And TI might start looking for loopholes to get out.
But that's exactly why you want to be in this stock. If a recession hits, the rest of the market could crash. The S&P could drop 20%. But SLAB is anchored to that 231 cash offer. It becomes a safe haven. The deal creates a floor. As long as the deal holds, the stock price is basically immune to a general market recession.
Immune. It's highly correlated with the deal probability. In a recession, deal probability drops. The spread widens. You could see the stock drift down to 180 or 170 just on fear, marking a paper loss for anyone who bought at 203.
Let's maybe pivot back to the CEO for a minute, Matt Johnson. I think his track record gives investors some comfort here. He came from NXP, Freescale, Fairchild. He knows the game. He successfully divested the automotive business back in 2021 for $2.75 billion. He has proven he knows how to unlock value. and employees rate him 80 out of 100. That cultural alignment is crucial for keeping the engineering team together during this 15-month limbo.
I'll give you that. Johnson is a solid operator. He kept R&D spending up during the 2024 downturn, which is why they have the Series 3 now. But once the deal closes, if it closes, he's likely gone, or just folded into the massive TI machine. The Silicon Labs culture, that innovation engine, it risks getting crushed by the Texas Instruments bureaucracy. TI is efficient, but they aren't exactly known for being nimble innovators in the wireless space.
I disagree there. TI is a machine, yes, but they have a massive sales channel. They have 100,000 customers who are currently buying analog chips from TI and wireless chips from Nordic or someone else. Now TI can cross-sell. Here's your power management, and by the way, here's your Matter-compliant Bluetooth SoC. That cross-selling opportunity is exactly what justifies the price.
I'm sorry, I just don't buy that the cross-selling is automatic. Engineers choose the best chip for the job. If Nordic's chip is better, they're going to buy Nordic even if TI offers some kind of bundle. And Nordic is singularly focused on wireless. TI is focused on, well, everything. And focus usually wins in semis.
Protocols like Matter. It's becoming less about the radio magic and more about the software stack and the security. And that's where Silicon Labs Silicon as a platform shines. Their Secure Vault is the first to achieve PSA Level 3 certification. Security is the killer app for IoT, not just radio range. TI knows this. They are buying the security stack as much as they're buying the silicon.
Security is important, sure, but is it worth a 69% premium? We keep going back to the price. $231 is a steep price for a company that just finished a year with $785 million in revenue.
But that revenue grew 34% year over year in 2025. The trajectory is straight up. You're looking at the rearview mirror. TI is looking at the windshield.
And I'm looking at the regulatory roadblocks in the middle of the highway.
Let's summarize where we stand then.
Look, for me, this is an arbitrage play, plain and simple. It is not a growth investment anymore. The upside is strictly capped at 231. For me, that 15-month wait is just too long given the high beta risks of this market. You are picking up pennies in front of a steamroller named Sam. If China blocks this, you lose 30 to 40% of your capital instantly. I'd rather be in the SSOX index or a competitor like Nordic if I want wireless exposure.
And I see it as a rare opportunity to buy a high-quality asset at a discount to a locked cash offer. A 13.65% spread is an attractive yield for the patience that's required. The strategic fit, combining SLAB's wireless protocols with TXN's manufacturing scale, makes this a high-conviction deal. Texas Instruments needs this to compete in the $1 trillion semiconductor future. They will move heaven and earth to close it. This is a defensive, calculated play for a smart portfolio.
It's the end of an era for Silicon Labs as an independent company, that's for sure. The IoT pure play is getting absorbed into the Borg.
Merging into the massive Texas Instruments machine might be exactly what this technology needs to reach a truly global scale.
Or where it goes to die in a regulatory filing cabinet?
Only time and the regulators will tell.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.